Alright, let's not waste a single second. We're diving straight into the core rules of this strategy. This entire system works on the 4-hour chart, but every powerful decision you make, every direction you choose, starts from the daily chart. Why? Because the daily chart is where the big money moves live. It's where major trends begin, where momentum forms, and where you can spot the exact zones that push price higher again and again. Here's the mission. We're hunting for major price movements that start from key value areas, zones on the chart that the market clearly respects. These are the levels where price launched upward before, and when you look to the left of the chart, you'll often see multiple reactions proving how strong these levels are. Your job? Track those zones, follow them, and position yourself where the market has already shown its strongest behavior. You're basically surfing the biggest waves the market creates. But to actually use this strategy like a pro, you must understand two crucial concepts: trend and market structure. And trust me, I know these two can feel insanely confusing when you're new. Sometimes the chart looks like it's trending, then suddenly it's consolidating, then it breaks again, and boom, everything feels random. That's why in this video, I'm giving you extremely clear, battle-tested rules that anyone can follow. Rules that help you instantly see the difference between a trending market, a consolidating market, and which value areas the market respects the most. Once you understand this, you won't just look at the chart, you'll finally read it. And from there, everything about your trading becomes easier, smoother, and way more consistent. Alright, let's keep this off with the very first part of the strategy. And trust me, this part is so simple that once you get it, you'll never look at charts the same way again. Step 1. We must identify the trend on the daily chart. And the fastest, cleanest, no-nonsense way to do that is by adding the 50 EMA. This single indicator instantly shows you where market structure is forming and gives you the main reference point for finding high-quality entries. It's like turning on a flashlight in a dark room. Suddenly everything becomes easier to read. Here's the pattern we're hunting for. Price pushes upward, creates a higher high, then pulls back to retest the previous high it just broke through. That retest is where all the magic happens. That's the zone where continuation trades show up, where momentum keeps flowing, and where we have the chance to ride the trend for as long as it stays strong. But of course, the market isn't always kind enough to move in a perfect staircase pattern. Sometimes price gets messy, sometimes it fakes you out, and sometimes it looks like it's trending even though it's actually just chopping around. That's why the 50 EMA becomes our trend filter. What I'm specifically looking for is the highest high above the EMA 50. For example, in this scenario, we have a clear high right here. If price is currently sitting around this area, then that is the official highest high above the EMA 50. And I need to see that high get broken before I'm allowed to even think about buying. And once that highest high finally breaks, boom, two confirmations appear instantly. First, we know the market is in a legitimate uptrend. Second, we now have a validated level to start hunting for buy setups. That single break tells us, hey, the trend is alive, and that's our green light. Now here's an important twist. If price drops, bounces a bit and forms a new low below the EMA 50, that becomes the start of a downtrend. In that situation, I completely flip my bias and start looking for selling opportunities. But for now, let's stay focused on the bullish example so the concept sticks perfectly. As price continues climbing and forms a new high, our highest high above the EMA 50 shifts to the new level right here. Before I consider it valid, I must see another clean break above that high. And look, price does break through it. That means the trend is still strong, and that level is officially another key value area where we'll hunt for entries on the 4-hour time frame. We'll get into the full entry strategy shortly, but right now I want you to laser focus on mastering this trend and structure concept. This is the foundation of the entire system. If you understand this, the rest becomes 10 times easier. Watch price move forward and you'll notice that the nearest highest high above the EMA 50 forms right here. Same process again. I wait for price to break it, then I wait for a pullback, and only then do I start looking for buy setups using the 4-hour rules you'll learn later. I hope this walkthrough gives you a super clear understanding of how I read the trend on the daily chart, how I identify valid market structure, and how I pick out the key levels that set up the best entries on the lower time frames. Once you solidify this, you're going to see charts with a completely new level of clarity. All right, let's flip the script and look at the bearish example, because once you understand both sides, you're basically unlocking X-ray vision for reading the market. And trust me, this is where so many traders get trapped. They see a couple of candles wiggle up and down and suddenly they're screaming trend reversal, when in reality, the market isn't reversing at all. It's just shaking out beginners. So here's what usually happens. Price is dropping, everything looks bearish. Then suddenly the chart gives you this little bounce, then another push down, then boom, you get a surprise spike up, breaks a previous high, and even pokes above the EMA-50. And beginners instantly panic and assume, okay, that's it. This is definitely an uptrend. But no, that's one of the biggest mistakes you can make with this strategy. That spike means nothing unless it meets the very specific criteria we're about to break down. For our method, there are only two scenarios that actually matter. Scenario 1, price drops and prints a brand new low under the EMA-50. That's the market raising a giant red flag saying, hey, this is the beginning of a downtrend. Scenario 2, price drops, then bounces and climbs above the EMA-50. But even then, I cannot call it an uptrend until I see a fresh high that forms above the EMA-50 and can be compared to a previous high that was also above the EMA-50. This is the key. This is the blueprint. You must see what I call the 1, 2, 3 move. 1, a previous high above the EMA-50. 2, a breakout that forms a new high, also above the EMA-50. 3, and that structure must clearly break the old high. If these three pieces aren't there, it is not an uptrend, not even close. So here's the simple rule you live by. If price isn't making a new high above the EMA-50 or a new low below the EMA-50, then everything in between is just noise. It's not a trend, it's not reversal, it's not the market reverting, changing direction. It's pure consolidation, nothing more than the market catching its breath while inexperienced traders get tricked into bad entries. And once you understand this, you stop guessing and you start reading the market like it's speaking directly to you. All right, let's break this down in the bearish direction. And I want you to follow along closely because once you understand this, the charts will start making so much more sense. We're talking about trend and structure identification, but in a way that feels simple, powerful, and super obvious once you see it. So here's where we start. What is the lowest low below the 50 EMA? That's the key question every time we're dealing with a downtrend. And right here, this is the lowest low. That's our anchor point. That's the level price must break if we want proof that the market is still pushing down with real strength. Now, watch what happens when we push price forward just a bit. Boom! We get a clean, strong break below that previous low. And the moment that happens, the market basically shouts, yes, we're still in a downtrend. That break confirms two things. 1, the trend is still moving downward. 2, this zone is now a fully valid structure area where we can start hunting for high probability trades on the lower time frame. You'll notice price actually comes back into that zone and pushes even lower, exactly what we want to see in a healthy downtrend. But we're not done. In a bearish market, we always need to track the next lowest low below the 50 EMA. So now we're asking again, where's the new low? Where's the next floor price needs to break? And here it is. This is the new lowest low. Now we wait. Do we get the break? Yes. Price slices right through it. Beautiful. That gives us another confirmed structure level, another zone we can use to plan trades on lower time frames, and the process repeats. Simple, mechanical, predictable. Now let's keep moving. Price pulls back and then forms another low right here. This becomes the new lowest low below the 50 EMA, and sure enough, we get another push downward that breaks it. And once again, that tells us the downtrend is still active, the structure is still valid, and this level becomes another area where potential entries might develop. But now comes something super important, a nuance that trips up thousands of traders. Look closely. At one point, price actually pushes upward and moves above a previous swing high. And a lot of people instantly freak out and assume, Okay, that's it. The trend is reversing. But that's not how this strategy works. Breaking a swing high does not put us into an uptrend. It means nothing unless price forms a new high above the 50 EMA and then breaks that high into even higher highs. That's the only time we classify a real uptrend. So even though price popped up into this zone and didn't give us any valid entry setup, the overall trend never changed. We are still in a downtrend, and even if price keeps pushing higher temporarily, we always respect the major higher timeframe structure levels because those zones often become powerful areas for future bearish opportunities. Once you understand this rule, that a true reversal requires a very specific pattern above the 50 EMA, everything becomes clearer, no more guessing, no more false signals, just clean logical structure reading that makes the market feel predictable instead of chaotic. Now at this point, you should already have a solid grasp of the first phase of this strategy, identifying the trend and locking in the key structure levels that actually matter. And in the bearish example we're breaking down, everything is built around one simple idea. Price keeps driving lower, smashing through fresh lower lows while staying below the 50 EMA. Once that happens, we're waiting for a pullback right back into the previous support zone that was just broken. And the moment price snaps back into that level, boom, that's where the real action begins, because right after that pullback, the big question hits. What's the next move? What exactly are we looking for? And this is where my entire trading system becomes insanely clean. Because every strategy I use follows the same formula, CEST. Conditions, entries, stops, targets. If a strategy doesn't have crystal clear rules for all four, it's not a strategy, it's a guess. And we don't guess here. We already covered the conditions. The trend is down, structure is clear, and price is pulling back into a value zone. So now we move on to the entry step. And to do that, we drop straight into the 4-hour chart because this is where we fine-tune the timing, the precision and sniper-like confidence behind every trade we take. Take a look at this example. On the daily chart, we know the previous lower low is right here. Price broke through it, retraced, and climbed right back into that exact level. So I highlight this zone with a box, that old support which now has the potential to flip into brand new resistance. That's the area where smart traders sharpen their focus. Now we jump into the H4 chart. Here, I need to see price actually tapping that daily level. Not almost touching it, actually hitting it. And once it taps the zone, I'm waiting for what I call a candlestick combination, a clear pattern that tells me sellers are stepping back in with real momentum. At this point, the conditions are 100% met. The daily trend is clearly bearish. Price has re-entered a high value sell zone. We're on the lower time frame, ready for precision entries. Now, what candlestick pattern are we looking for? I want something obvious, something aggressive, something that screams, sellers are back. My favorite setups are patterns like a shooting star or hammer, followed immediately by a strong candle in the direction of the current trend. If I'm looking to sell, that means after a shooting star, I want to see a big, confident red candle slam downward as confirmation. You can use engulfing patterns too, bullish or bearish, but what matters most is the follow-up candle. That second candle must agree with the trend. If the trend is down, I want that next candle to be red, sharp, clear, decisive, because that's the moment the chart tells you, all right, the trend is real, the pullback is done, the zone is reacting, let's go. All right, now things are about to get really exciting because at this point, we've already locked in the first two letters of this entire system, C and E. And trust me, these two alone can change the way you see the charts forever. C stands for conditions, and this is where everything begins. It means the market on the daily chart has to be trending, not ranging, not confused, trending. Then the price has to pull back into a clean logical value area, exactly like the rule we talked about earlier. No guessing, no maybe, no hoping. The conditions must line up or we don't touch the trade. Period. Then comes E for entries, and this is where you zoom in and catch the moment the market reveals its hand. These aren't random candle patterns. These are high probability momentum shifting signals. For a bearish setup, it might be a sharp shooting star that gets punched down immediately by a red candle, or a strong bullish candle that suddenly gets crushed by a bearish engulfing, followed by one more red candle to confirm the shift. These are the patterns that flip the bias and let you strike fast. But now it gets even better because C and E are not enough. To actually trade like someone who knows what they're doing, you need the next two letters of this formula, and this is where everything becomes real. You need S for stops and key for targets. Without these, you're not trading, you're gambling. You must know exactly where you're wrong and exactly where you're taking profit when price moves your way. For this example, I placed the stop loss just above the structure zone I marked earlier, but to keep it insanely simple for you, imagine placing your stop about 20 pips above the high of whatever candlestick pattern triggered your entry. Clean, simple, no drama. Then, for your take profit, let's say you aim for a 1-3 risk to reward. That means every time you risk $1, you aim to make $3. And honestly, for this kind of strategy, that is insanely reasonable. And you don't need to chase perfect numbers. You don't need magical Fibonacci extensions from outer space. You just need clear rules for conditions, entries, stops, and targets. Because when you have these four pieces in place, you stop trading emotionally, you stop second guessing, and you start trading with consistency. The one thing that actually makes people money long term. That's the whole point of your system. Not perfection, consistency. Follow the rules. Trust the process, and the results begin to shift one trade at a time. All right, let's jump straight into the action because now we're looking at all 5 major pairs on the daily chart, and I'm going to tear them apart with you using this exact strategy step by step so you can see exactly how professionals think before they ever even touch the buy or sell button. First up, EURUSD. Now look closely. What is happening here? The market isn't trending, it isn't exploding up or crashing down, it's basically stuck in a tight, boring consolidation box. It's moving sideways like it's waiting for something big to happen. So before I even think about selling or buying with this strategy, I need one thing, a real breakout. Something strong, something obvious, something that makes you say, okay, the market finally made a decision. Here's scenario number 1. If I see price break below these two super close low levels, this low and this low right here, with a clean, solid, undeniable candle close below them, then boom, that's my confirmation. Only after that breakout happens will I draw my structure zone connecting those two lows. Then I wait, patiently, for price to pull back into that zone. And when it does, that's where I start hunting for a 4-hour sell entry, precisely at the levels I've marked. Now let's flip the script. Scenario number 2. If instead price explodes upward and breaks above these two super close high levels, this high and this one, again, I'm not satisfied with just a wick. I need a real body close, something strong, something you can't ignore. Once that happens, I draw the structure zone connecting those two highs. Then I wait again for price to come back, tap that zone, and once it does, I immediately shift into buy mode looking for a 4-hour buy entry right inside that area. And here's the most important part. If neither of those breakouts happen, if price just keeps dancing sideways with no conviction, I do absolutely nothing. No guessing, no forcing trades, no emotional maybe this will work. Just pure discipline, clean, objective, mechanical decision making. All right, let's fire up GBPUSD because this pair is basically shouting its entire story at us. And honestly, this one is beautiful. It's clean, it's obvious, and it's the kind of structure traders dream about. We're not guessing, we're not confused. This is a pure, undeniable, screaming downtrend. Watch what the market does. Price tanks downward, pops up just a little, then gets absolutely slammed again, breaking through the previous lowest low like it wasn't even there. Then it tries to bounce, weak bounce, no strength, and completely fails to beat the last high. And after that, price collapses again and plows straight through the key value area. It's like the market is holding a giant neon sign saying, hey, I'm going down. And if that's not enough, the entire move is sitting comfortably below the 50 EMA, which is basically the market giving us a second confirmation, like it's saying, yep, still dropping, don't overthink it. So now what's happening? Price is crawling its way back up into that key value area. And this is the exact moment we prepare for action. This is where traders who know what they're doing sharpen their focus, because this is the zone, the hot spot, where high probability sell setups are born. This is where I jump to the 4-hour chart, zoom in, and start hunting like a predator looking for the perfect timing. I'm checking for rejection, pressure, confirmation candles, all the signals that tell me, okay, this is it, the market is ready. Enough talking. Let's get straight into the GBPUSD H4 chart and break down exactly how we find that high probability sell entry. Let's go. All right, take a good look at the screen because this is the moment that matters. This is the H4 chart of GBPUSD, and on this time frame, we've got a massive amount of space to hunt for the perfect sell signal. This isn't just any random zone, this is the key value area, the exact place where high quality opportunities usually pop up. And in this area, we're not just guessing, we're waiting for a signal that is crystal clear, a signal that even a complete beginner could point at and say, yes, that's the entry. Your sell signal can come from anything, a strong candlestick pattern, a clean chart pattern, whatever it is, the rule is simple. It must be obvious, unmistakable, and easy to identify. If the signal looks unsure or messy, skip it. A weak signal inside a powerful key value zone can destroy profit that should have been yours. For example, if you spot a bearish engulfing pattern, that engulfing candle needs to be big, needs to be clear, and it must be followed by another candle that also pushes bearish. We want to see the market actually falling, not just wobbling around. Or if you see a chart pattern, like a double top, make sure that pattern is sharp, clean, and undeniable. You want the kind of pattern where you instantly feel, yes, this is momentum. And now the most crucial part, stop loss. Place your stop loss a few pips above the key value area, not too tight, not too far, just enough space for the market to breathe while still protecting your account. And once that's locked in, your target becomes simple but extremely powerful. Go for at least 3 times your stop loss distance. That means a small stop loss can still generate a big reward. This is how you turn one great entry into a profit that actually feels big. So the formula is simple. Wait for a super clear signal, confirm the momentum, protect the trade with a smart stop loss, and aim for 3x the risk. When you do that, you're not just trading, you're trading with confidence, precision, and total control. All right, let's jump straight into USDJPY because this chart is absolutely screaming with momentum right now. Before we dive deep, let me ask you a super simple question. What do you think the market is doing here? Uptrend, downtrend, sideways? If you looked at it even for half a second, you already know the answer. This thing is clearly, unmistakably bullish. And the best part, the structure is ridiculously easy to read. We're talking about a textbook uptrend, one of the cleanest you'll ever see. Watch closely. Price pushes up, then dips a little, but that dip can't even break the previous low. And then boom, out of nowhere, the market explodes upward, leaving a wide bullish gap and blasting straight past the previous high. When you see something that strong, it's like the market is yelling, I'm going up and nothing can stop me. But it gets even cleaner. Price pulls back again, tries to move lower, and fails. It can't even close the bullish gap because buyers rush back in and shove the market upward from the key value area. Price then breaks the previous high again, forms a brand new key value area, dips into it, and launches upward once more, smashing through the next higher high. And guess what? A new key value area shows up again, perfectly aligned with the structure of a powerful bullish trend. And right now, at this exact moment, price is simply doing a correction. It's not reversing, it's not collapsing, it's just breathing, pulling back naturally after a strong push. So what do? We wait patiently. We wait for price to drop into that key value area below. Once it taps into that zone, that's our green light to jump to the H4 timeframe and search for a clean, powerful buy signal. Take a look at the H4 chart. This is where the magic happens. In the next few days, price might slide down just enough to touch the key value area we're watching. And if it does, we're ready. We'll be locked in, watching for that candlestick pattern or chart pattern that screams buy. But let's say something else happens. Let's say price refuses to correct deeply and instead rockets upward again without touching that key value area. No problem at all. In that case, we jump back to the daily chart, run a fresh analysis and look to the next new higher high. If price breaks above it, that instantly creates a new key value area. Then once price finally pulls back into that new zone, we go straight back to H4 and hunt for our next high probability buy setup. It's simple, it's logical, and it's insanely accurate when you follow it step by step. Alright, let's jump into NZDUSD, because this pair is setting up something seriously exciting. Look at what's happening right now. Price has just slammed straight into the 50 EMA, and at the exact same moment, it's also touching the most recent key value area. And this isn't just any random zone. This area has been respected again and again if you scroll far back in the past. The market treats this level like a sacred line, and every time price touches it, something big happens. And on the daily chart, the story couldn't be clearer. This market is in a strong, clean, bearish trend. So what do? We don't waste a second, we immediately drop down to the H4 timeframe to hunt for a high probability sell setup. And the moment we open the H4 chart, boom, you can already see something forming. It looks like the market is trying to build a potential double pattern. And if this double top completes perfectly, that's our signal to strike. Here's what that means for us. If the pattern forms cleanly, 2 clear peaks, obvious resistance, and a price reaction, we take the sell. But we don't just jump in blindly. We place our stop loss safely above the key value area, giving the trade room to breathe, and we aim for a target that's at least 3 times our stop loss. That's how you take high quality, high reward trades. But here's the most important part, and I want you to really hear this. We only enter the trade if we see a clear, undeniable, powerful entry signal right inside that key value area. If the signal isn't clean, if it's messy, if it's confusing, then we do not enter. No guessing, no forcing trades, no emotional decisions. That's how traders lose. And don't ever feel disappointed if the setup doesn't complete, because trust me, with these trading rules, the perfect opportunity always shows up somewhere else. If the market doesn't give us a clean entry this time, it will give us an even stronger one later. One with massive probability and massive potential. Our job is simple. Stay patient, stay disciplined, wait for the clean signal, and when it appears, we strike with confidence. Now imagine this. What if the price doesn't stop falling and instead suddenly shoots upward and completely smashes through that key value area? What do we do next? Simple. We don't panic. We don't guess. We instantly snack to the daily time frame because that's where the real story begins to unfold. And on the daily chart, we wait for one thing, a brand new higher low to form. And this higher low isn't just a random wiggle on the chart. Oh no, this is the moment everything shifts, because the second price breaks above the 50 EMA, that tells us visually, loudly and clearly that the market has flipped into bullish mode. And when a higher low starts forming right after that breakout, it's like the market screaming, yes, the bullish structure has officially begun. That's our confirmation that the trend has changed. The momentum is real, and we're no longer dealing with a weak correction, we're dealing with an emerging uptrend. And once we see that higher low forming, here's where the magic happens. A brand new key value area appears, and this new zone becomes our mission target. Because if price pulls back and starts dropping into this fresh key value area, boom, that's when we jump back to the H4 chart with full focus to hunt for a crystal clear buy signal. Candles, patterns, momentum, whatever the signal is, it must be clean and undeniable. If it's clean, we strike. If it's messy, we wait. No exceptions. And the crazy part? This process is actually unbelievably simple once you understand it. You're literally just following the structure, watching how price respects the EMA, identifying the key zones, and waiting for the market to give you the green light. That's it. The real superpower isn't a secret indicator, it's your patience, your discipline, and your ability to stay sharp while everyone else rushes in blindly. Stay calm, stay focused, and follow the rules, and the market becomes so much easier to read. Now let's jump into Aussie dollar, because this one is wild. And before we dive in, remember this. This strategy is not locked to just Forex. You can literally take this exact same method and apply it to crypto, stocks, indices, whatever market you want. The rules stay the same, the logic stays the same, and the consistency stays the same. That's the power of understanding structure instead of guessing. So here's what's happening on Aussie dollar right now. On the daily chart, I call this an anomaly, like the market is sending mixed signals and daring you to get confused. But we don't get confused, we break it down. If you look strictly at the market structure, everything screams bearish. Lower highs, lower lows, the classic staircase of a downtrend. If we only follow structure, the trend is clearly pointing downward. But here's the twist. Even though the structure is bearish, the price right now is actually sitting above the 50 EMA. And the 50 EMA isn't pointing up, it isn't pointing down, it's completely flat. And this is huge. When the EMA is flat like a ruler on the chart, it means the market isn't trending strong in either direction. It's not bullish, it's not bearish, it's basically neutral, and that instantly kills the quality of any trade setup. And that's why with this strategy, we simply step back. We don't force a trade, we don't chase anything. We temporarily ignore Aussie dollar and leave our attention to the markets that actually offer clean, high probability opportunities, the ones I showed you earlier. Because your job isn't to trade everything, your job is to trade only the best setups. And now you can clearly see why this strategy is insanely accurate. It's because you're not jumping blindly into entries. You're not relying on a candle pattern popping out of nowhere. You are reading the market's actual condition before you touch the buy or sell button. And that skill, understanding the environment before the entry, is 10 times more important than any candle pattern in the world. And once you've mastered identifying the conditions, you can use any pattern, price patterns, candlestick patterns, combinations of both, as long as they appear inside the key value areas, backed by structure, trend, momentum, and all the technical factors we're using here. There are even more advanced nuances I wish I could break down for you, but we'd need a whole separate video just for that. The point is, when you understand the battlefield before you step onto it, your winning rate skyrockets. If you're serious, like really serious, about becoming a consistent and profitable trader, then listen closely, because this is the part most beginners never understand. You must master at least one solid strategy as your foundation. Not 10 strategies, not 20 indicators, not a bunch of random setups you saw on social media. Just one strategy you can actually follow, repeat, and trust. And the one you learned in this video can be that starting point. But here's the twist that shocks most people. Mastering a strategy alone is not enough. You need two more elements, equally powerful, equally essential. And when you combine all three, they form what I call the ultimate triangle of trading success. And right in the center of that triangle, that's where the real long-term profitable traders live. That's the zone you want to reach. These traders have mastered a strategy with clear, repeatable rules. Rules they follow with zero guesswork. Rules that actually work over the long run instead of just looking good once or twice. They've also locked in their risk management, meaning they stay calm under pressure. They don't panic, they don't chase losses, and they only risk amounts that keep them mentally steady instead of emotionally exploding. And the final piece, the part that makes or breaks almost everyone, is trading psychology, especially discipline around stop loss. This is what keeps them alive in the market year after year, while thousands of beginners blow up their accounts every single week. When these three elements snap together, strategy, risk management, and psychology, you stop gambling and start trading. That's when consistency finally kicks in, and consistency is the real engine that prints money in this game. Not luck, not hype, not hoping. Consistency every single day. I hope you enjoyed today's video because I put everything on the table for you. If you found value here, smash that like button, it helps more than you know. And if you're new to the channel, hit subscribe so you don't miss the next breakdown. I hope the rest of your week goes smoothly. I hope every trade you take is green, and I can't wait to see you in the next video. Let's keep growing, let's keep learning, and I'll see you there.